Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, you were sharing with the team recently that the Trump bump, the so-called Trump bump, is easing. So the NASDAQ hit a record high, but the Dow was down at the same time? Is that right?
So we've had this week all-time highs for the S&P 500, which is the most broadly watched index, and then the NASDAQ composite, which is very tech-heavy, all-time highs as well. And that is likely to continue at least through probably through the inauguration. Now, there may be a little bit of a pullback that we'll experience over this week coming up, and that's due to what's called capital gains distributions from investment vehicles like mutual funds. So this is the time of year that they have to declare gains in there, and so a lot of growth funds have had great success owning Apple and Meta, Facebook, Amazon, and of course NVIDIA. Well, if they want to lock those gains in and are fearful of any kind of change after the new year, they sell those positions. Well, Chip, the shareholders of record have to pay the tax liability on those mutual funds, and this is where people, even inside their IRAs, pay sometimes referred to as a phantom tax they're not aware of, and these distributions come out. But there's so much money that has to come out and pay the tax liability that the shares drop in value the day they do this, and so that can lead to a 2 to 3% drop in the market all by itself. But barring anything crazy, although we had some crazy stuff as of the recording of this morning, South Korea declared martial law, if you saw that. So we've had some crazy headlines, but we just think you're still going to do the traditional year-end market melt-up, and it will probably continue making subtle new highs between now and Trump's inauguration January 20th.
You were also talking about tariffs, and there's news on several fronts there. Trump kind of let it, well, maybe didn't let slip. He made it known, well, maybe we need to hit Canada with some big tariffs. Well, presto, Justin Trudeau turns up at Mar-a-Lago. And so what do you think? Are we going to see tariffs or not, at least with regard to Canada?
Well, the old adage they used to say, hey, kiss the ring, so to speak. When a new leader comes in, you kind of have to pay your homage. And we saw Mark Zuckerberg of Facebook/Meta, make an appearance there. Hey, look, we want to be open-minded. We want to have a platform that is free where all sides are out. So because they know that, the woke agendas, if you will, have been punished, and the pendulum has swung the other way now. And so companies are going to quickly realign. DEI is getting, canned everywhere in government agencies, universities, all that. But yeah. And then he went and basically said, you know what? This border is not really our problem. It's our neighbor's problem. It's Mexico and Canada. And so what? We'll just put 100% tariffs on these countries until they shut the border down. Pretty simple. And, he's going to fight fire with fire. And the Mexican president, I forget her name at the moment, but she's a socialist and the newly elected president there last year. And she kind of had some tough rhetoric at the mic and quickly backed away from that on speak. And then, like you said, Trudeau was at his house within 48 hours in Mar-a-Lago to meet with him. And, hey, let's play nice. And the line of the night was we don't want to pay tens of billions of dollars in tariffs. He's like, well, maybe we'll just annex you and make you the 51st
state. Oh, my. That'll go over well. Okay. Now, Trump was also threatening to play the tariff card with the so-called BRICS nations. We're talking about Brazil, Russia, India, China, Saudi Arabia, and you mentioned there may be some others joining that group. These are nations that they basically want to supplant the dollar, right, as the world's reserve currency, is the default currency for world transactions?
Yeah, so we've been tied since the 1950s to what we refer as the petrodollar. So typically all the oil from OPEC producing nations has always been traded in dollar terms. That has lost some of its effectiveness over the last decade or so. And so these other countries and other powers would love, especially China, to have people look at another currency as the world's reserve currency. And again, people get a little scared. Oh, the dollar's going to die. It's going to crash. We are still 68% of every transaction on the globe. And that's only down from about 71% 10 years ago. So not a huge significance there. The dollar is not going anywhere. Too many people have too much to lose. However, they certainly want to continue to trade in rubles, yuan, and other vehicles, euros, et cetera. So basically, if they act inappropriately and it looks as if they are trying to destroy the dollar, he was going to put a 25% tariff on those countries. So again, using these tariffs as a tactic, and he's getting movement without even having to do anything. So, and that's where, he's playing checkers where others are playing chess. He's 5 or 6 moves ahead of these people. Some of the rhetoric he does has no intention of actually implementing it, but it's to get a perceived reaction and then get someone to come to the negotiating table. All you have to do is read The Art of the Sale, right? It's one of Trump's first books. I read that when I was in my late teens, and so this book had been around for 40 years, and all these tactics are laid out in his book. So I would advise any of these politicians or leaders of other countries, you might want to get a copy of that book and understand how he's going to come at you. But I think it's great because it's newsworthy. He's moving the needle, and you're stirring the pot up, and that's what people want to see. This election clearly says people voted for change.
Well, the Trump entertainment factor, I guess, is already in play. He's already moving the needle on tax policy, and he's not even in office yet. Actually, there's more to say about potential Trump tax policies. Evan Marshall's going to join us in the second segment of today's show, Evan of Tax Smart, and you and he can visit in a little more detail about what we might expect from a Trump administration when it comes to tax policy. David, I want to turn next to something you shared with the team. Normally, when you send out these charts and graphs and so forth, I can at least generally get it. But this one's going to require some explanation, a load of debt. It has to do with the 2025 debt that the nation is facing. And why don't you, for listeners and for YouTube viewers, tell us what we're looking at, and then what does it actually tell us?
So what we've got on the screen is a chart of the $36 trillion that we owe, right? The debt load that we owe as a government. And by the way, that's over $290,000 per taxpayer. So swallow that one. All right. So, but what we're looking at is, you'll notice this chart goes from 2023 all the way out to 2054, right? So it goes out 30 years in maturity. And you can see from basically about 20 years all the way out to 30 years, Chip, very low blue bars there. That's the amount of debt that would get refinanced in each of those years. The problem is the current the Treasury Secretary, Janet Yellen, has been playing a few tricks and refinancing all the debt on very short-term maturities using T-bills, so 2 years or less. And as you can see, in 2025, it's $7 trillion. That is that big spike that has to get refinanced next year. Well, interest rates have actually gone up since the Fed started cutting rates, not gone down. The 10-year Treasury is still well above 4%. All this debt that you see currently has an average interest rate on of just 2.76%. If we refinance at current rates just the $7 trillion next year, and then it's about $5.8 trillion the following year, the average is going to go up over 100 basis points to about 3.8% on that debt. And that alone will take the interest payments due on our debt for the next fiscal year from $1.2 trillion to $1.8 trillion. So that's $600 billion in additional interest payments because Janet Yellen tried to hide this debt refinancing in what I believe is a political move because she wanted to have better numbers so Biden would get reelected.
I'm not the numbers guy in this conversation, but isn't that about a 50% increase when you go from 1.2 to 1.8?
It's exactly what it is.
Even I can do that math.
So Trump's new secretary, Scott Bessert, has got quite the workload here to figure out what to do with this. Normally speaking, we usually finance about 40% of our debt on shorter maturities, 7 years or less, and then about 60%, 10, 20, 30-year maturities when we're financing debt. And what boggles the mind is when interest rates were basically at zero, you should have financed everything as long as you could have, right? Lock in the lower rates for longer. And so just like everybody that's got a mortgage sub 3% is probably not selling their house or getting rid of their mortgage, it's the same thing. Why wouldn't you have financed all this longer term, not shorter term? And so because it would have been exposing the current administration for all their wasteful spending, et cetera. And so they were hiding this by just spending on the short term. It really didn't show up on the balance sheets the way it's going to just explode in the near future.
Well, and remember when we talk about paying this off, refinancing, and so those are your taxpayer dollars. That's coming out of your pocket.
And the scary thing is, where are they going to get the money? The Federal Reserve is losing money hand over fist right now. And remember, Warren Buffett's Berkshire Hathaway is now over $300 billion in cash and cash-like instruments and T-bills. They hold more T-bills than the federal government.
David, we've talked about this next topic anecdotally for the last year or two, and now comes the National Association of Realtors with a study and data documenting it. Top states Americans moving to, dominated by the South. We've talked about Californians going to Texas and New Yorkers going to Florida and so forth. And David, it's not for the warm weather.
No, and it's no surprise where the migrants went. Number one, of course, was Florida. Number two, I believe, was Texas. I think you had North Carolina and South Carolina, respectively, in the top five as well, and Georgia. So all along that southern kind of belt area on the East Coast. But it's not, as you said, it's not because of warm weather, because you had people moving from California. You had people migrating out of New Mexico, some out of Arizona.
California saw the most out migration. I think it was about 75,000. So, yeah, it's not weather that's an issue here.
It's regulatory policy and tax policy in these states. Is becoming too burdensome for people to maintain their style of living, right? And so, like here in Nebraska, we have this argument all the time. Our property tax burden is so significant that we have people choosing to move away for retirement, or even those that are thinking about starting a family, because to purchase your first home here, as our producer, Shannon, is closing here in about 2 weeks on his first home. One of the things I have to coach young home buyers on is, hey, make sure you're aware of what that cost is, not just the property, the mortgage, principal and interest, but the taxes and insurance are quite large today. When I bought my first home, the escrows were about $100 a month, Now mine
Not
are four,
anymore.
it'd be four digits. I don't have a mortgage, but if I had, and so it's you can't sustain that anyway. So the states that are making a friendlier place to do business for entrepreneurs to move their business, we're seeing a migration happen, and that's likely to continue.
Oh, Nebraska leaders, take note. All right, up next, tax planning. We are passionate about it at Retire Smart. CPA Evan Marshall of Tax Smart, our tax planning division, joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Are you an entrepreneur with tax concerns? Well, you have come to the right place. The head of our tax planning division, Tax Smart, is with us today. David, please welcome our special guest, CPA Evan Marshall.
Thank you, Chip. Yes, once again in the studio, I am joined with our resident tax planner, chief tax planning strategist, and CPA Evan Marshall. Evan, thanks for taking time to jump in the studio.
Thanks for having me, David.
So first off, congratulations. Not only do you have CPA, but you've got another set of letters that include CPA, CEPA, a SEPA designation. Tell us about that.
Doesn't get any more confusing than that. Need to have a little more creativity with my designations, but yeah, on top of the CPA designation, recently got the CEPA. Same with you, David, but CEPA stands for Certified Exit Planning Advisor. And essentially, it was a class that you and I took with a proctored exam to essentially train us on how we can better consult business owners and their potential exit when that time comes.
And the reality is, exit planning is not about the actual exit. It is at some point, but it's about preparing your company for the exit, whether it's your choice or not. Death, disability, divorce, the economy. You want to transition to your kids. You want to actually sell it. Private equity is interested. You may look at an ESOP. There's a myriad of options on the table, and this certification allows you and I to help coach these business owners along the path. And what's unique about the model that you and I have created is we can actually help them achieve those goals faster, higher valuation, et cetera, through creative tax planning, right? And proactive tax planning, which is what I think the typical entrepreneur is sadly missing today.
Absolutely. And one of the things they mentioned with the course is, you can have SEPAs. I could be a SEPA who maybe specializes in the tax planning, and working with a myriad of professionals who essentially speak the same language. And I know that'll be one thing that you and I really work with on our business at Owners is the tax planning portion of that exit, which is a huge piece of that.
Well, yeah. I mean, you and I recently sat with somebody who took a $35 million capital gain this past year, sold a business, grew it very successful, but unfortunately didn't really get any advice prior to executing the contract. And you were able to still come in after the fact and actually significantly show him how to reduce his tax liability. But, we want to do this ahead of time because it brings so many more strategies involved. In fact, I think recently you saved a local business owner about $200,000 on a case.
Yeah, and it was just one of those scenarios where they were working with the CPA, and it was one of those, hey, you made a lot of money, so you're going to have to pay a lot in taxes. And just reached out, wanted a second opinion, and we ended up having a few strategies that, saved him a significant amount of money here before the end of the year.
Well, I think that's fantastic. So if you're an entrepreneur out there and you're starting to grow your business and you feel your tax liability is maybe getting a little out of hand, you can get a free consultation. You would just email, I believe it's just help@gettaxsmart.com, right?
That's correct.
So help@gettaxsmart.com, and you can be set up a simple phone consultation to find out if tax planning is something that could put you in a better position. But speaking of tax planning, you also work with a lot of our clients on their retirement tax returns, et cetera. We save those clients lots of money via several tax strategies. But there's potentially some good news on the horizon. Obviously, the election kind of went to the right, if you will, a Republican sweep. And so most likely we're going to have some changes, but it's only going to be for a period of time. So right now people can choose to be proactive in a way maybe they didn't think they'd have the opportunity to be so.
Yeah, and with Trump being elected, this red wave that we're seeing, it gives us a little bit more runway. We're projecting a little bit more runway with the Tax Cut and Jobs Act, which would otherwise be sunsetting here soon. But otherwise, we're just evaluating what opportunities are coming just based on, what we're hearing, speculating on what really the first potential year of Trump's presidency is going to look like. But a lot of the initial strategies that we were taking advantage of previously, we'll still be able to with a little bit longer runway.
Yeah, so we believe at this juncture, we are probably going to extend the Tax and Job Act of 2017, or at least a good chunk of it. There's also talk of further reducing corporate tax rates from 21 down to potentially 15. The problem, though, and you brought this up to our team a couple of weeks ago in one of our team trainings, is when we cut the tax rates down and everybody basically got a 3 or 4% marginal tax cut back in 2017 when this passed, that added about 1.8 trillion to the deficit, right? And less revenue they were going to collect over the 7-year run. The problem now is the growth and scale of wages, et cetera. If we extend these through the end of the decade, which is what many people are predicting through 2030, this is going to add another $4.8 trillion to the deficit. Now, before people say, see, this is bad, it's tax cuts for the rich, we can grow our way out of this. So to be clear, we actually had record revenue in 2018 and 2019 prior to COVID hitting with these lower taxes. So we did actually widen the base, got more people making more money. Wage inflation was up across every ethnicity and every quadrant of the economy. So we actually did get more money in by cutting rates. So sometimes you have to take those projections from the CBO with a grain of salt. Oh, you're going to be deficit spending. So what's your take on this? So I don't think that he can not tax Social Security, even though I don't think it should be taxed, not tax tips, not tax overtime. I don't think you can get all that through and extend these tax cuts and abolish the estate tax, which is what some people think is going to happen. Where are you going to get all that lost revenue?
Yeah. And, one thing that a lot of people are speculating on is what is he going to be able to cut to offset this projected decrease in revenue. Obviously he's going to probably want to push a cut towards some of the green energy credits that Biden signed back in 2022. It's kind of one of those things, like a lot of the exemptions that he campaigned on, the Social Security exemption, the overtime exemption, those are really popular for voters, but how likely is he going to be able to get some of those pushed through Congress, especially with these deficit hawks that are really...
Yeah, people need to remember the Freedom Caucus, if you will, or the really fiscally tight folks in the House that caucus kind of together, and they want to see zero increase in the deficit. So you're going to have to show a way that you're going to grow your way out of this, project it. And of course, the one thing I think that Trump certainly has going for him here is with what's happened here in the last year in Argentina. And I've talked about it many times on this show in the last several months, but President Javier Milei down there just shredded departments of the government, and they had inflation running at 54%. It's now at 2.5%. And they actually have, they're projected to grow their GDP this next year by 8.5%, according to JP Morgan. So you can grow your way out of this, but there's a little pain along the way. A lot of government employees lost their jobs, and I anticipate a lot of government employees may be losing their job here in 2025 as well.
Yeah, especially with the push for more efficiency in our government. That likely means less people.
Yeah. Well, and with technology, why not take advantage of it? And on top of that, we have, I don't remember the exact amount of square footage, but the amount of buildings that we're paying full rent and utilities on as a federal government that could be subleased out if they don't need them or use them. It could be revenue generating, in D.C., which is a pretty expensive market to operate in as well. So lots of things to cover. So, we're not going to really know until the cabinet is fully met. They kind of project out what their agenda is and the first few pieces of legislation that they try to put before Congress. There's going to be a lot of executive orders coming out, I imagine, day one, probably at least 2 or 3 dozen of those. So we're going to have you probably back on just after that occurs to kind of let's lay out what we know now versus basically against what we're projecting for now. But so if you're out there and you're an entrepreneur, you're looking to how to mitigate your taxes, you do have a few strategies that Evan could help you with right now in the last 3 weeks of the year, but time is of the essence.
Time is absolutely of the essence. We say help me is a lot easier than fix me. So we're at the kind of the time crunch if you want to get anything done here before the end of the year. But we still have enough flexibility to get some action items taken care of.
All right. So again, if you want to get a hold of Evan, just email help@gettaxsmart.com. That's help@gettaxsmart.com, or click on our website and you can call the main number and we'll try to get you scheduled on Evan's calendar. Evan, we are out of time for this segment. Thank you so much for stopping in.
Thanks, David.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. The first question is about holiday economics. I know you guys track this stuff. What are you predicting this holiday season in terms of consumer spending? Will it be robust, anemic, or something in between? What do you see in your crystal ball, David?
We actually see it being more robust than last year, about 4 to 4.5% up. And I don't know if you remember, but last year we talked about doom spending on the credit cards. That appears to be happening again. So we had an okay Black Friday, but we had a record, what they refer to as Cyber Monday.
Give us a quick definition of doom spending.
So doom spending is where people are like, well, I might lose my job, or I only have $1,200 left on my credit card limit, and we might as well get something we enjoy for Christmas, new TV or toys for the kids. What have you.
So there's still some vestiges of that, you're saying?
Yes,
okay.
And so people feel like, you know what, I at least want to feel good. I'm buried in debt or what have you. And so we have record debt on credit cards. We have record interest rates on those credit cards. But the spending is up, but it's not. This is what's the key. So asking, do we track it? Yes, we do. We're not selling more goods and services. We're selling at a higher price those goods and services due to the inflationary pressures of the last 4 years. And so things are selling at a much higher price, but volume is down. Package count is down at UPS and FedEx, et cetera. So it's just costing us more. And then what's unique, Chip, is when we get into these times where we see people tightening the wallet, we see, and we talked about a couple weeks ago when the earnings came out for both Walmart and Target, right? The step down, we see the higher, more affluent buyers go from Target down to Walmart. This happens every recessionary period. What we usually see, but we're not seeing now, is the step down from the Walmart buyer to like the Dollar Tree or Dollar General, especially in rural communities. They go, and because these items are typically a little bit cheaper, maybe the quality is a little bit lower on certain things you could buy, but that's how these stores have thrived. They are not doing very well. So that's, at first I was like trying to look at what happened. Well, it's the Bidenomics, because the inflationary pressures hit the lowest income people the hardest, and they simply cannot afford to purchase some of those items. On top of that, Amazon has stolen the thunder of those retailers because they can just figure out a way to do it cheaper.
So that strata of consumers, you're saying that usually would go to Walmart, down to Dollar Tree, they're just opting out.
They're
Okay.
and surveys show they're not spending. They're not predicting
they're just
a robust
not spending at all.
Yeah, they're not spending anywhere near what they would have otherwise. And so you have those that are earning over $100,000 still spending, and that's where that 4% bump is coming from. But unfortunately, those under $100,000 significantly less sales.
So healthy, but not record breaking.
No, and the problem is this is not going to lead to robust earnings growth, because even while our sales top line numbers up 4 or 5% on the sales, the profit margin is not moving the needle because the input costs are higher, the wages are higher, et cetera. So we think profit margins will still get revised down for next year, which is, again, why we think the market, even though I just said earlier in the show, likely to continue making a few more all-time highs here in the next several weeks, the market is extremely overvalued by traditional metrics.
David, the next question is about financial strategies. We've had quite a run of questions recently about the dynamics of working with a financial advisor, and here's another one. My wife and I have been listening to your show for a while, and it seems that you look at investing differently than our current advisor does. We have a lot of mutual funds, some cash, and a small variable annuity. We retired a year ago. Our investments look the same as they did 5 or 6 years ago, but the financial world is not the same as it was 5 or 6 years ago. I worry that there are strategies we should consider for the changing financial environment. Is that something you do at Retire Smart? And how?
Yeah, I would say the answer is yes. We do things differently. Now, I got to remember and preface this: we can't give any advice to anyone that's not our actual client. But what I would tell you is yes, if the folks you're working with currently are not assessing your current portfolio, and it should be more than even once a year, monthly and quarterly, et cetera, on what changes you should be making based on where you are and what changed in your life. So and we deal with almost exclusively retirees, and what changes is they go from earning a paycheck to no longer earning a paycheck. So one, we need to make sure we understand where their income's going to come from, what portfolio should we pull that income from, what taxation issues are they going to have with that? What guaranteed sources of income will they have, like Social Security, railroad retirement, or if they're blessed with a pension, et cetera. And then we dive into how their investments are allocated. Now, they did mention he had a couple of products in there, mutual funds and variable annuities. Those happen to be some of the more expensive investments you can own today. Mutual funds were the most popular vehicle. It really became popular in the late 1980s and exploded through growth. But they are typically, and you might want to make sure you understand, if you look at your mutual funds, capital gains distributions are about to go out on those this week, most likely, which means it's going to lower the value. They have to pay taxes, and you as a mutual fund holder are the one that actually pay that per share. Even though you don't pay the tax bill, they pay it on your behalf and lower the value of your fund. And then you mentioned you had a small variable annuity. I'd always ask, what's the intention or the purpose of that? Variable annuities can get quite expensive in fees. While we will use annuities for clients in the right circumstance, we typically like annuities that have absolutely zero fees or expenses to them for the most part. And we don't like the variable part because those can lose value. So again, understanding what do you own and why do you own it? And if you don't know those answers, then it might be time to at least get someone to take a look and evaluate your situation and see, should I be rearranging things? Should I be changing things? And then one of the ways I help people just kind of visualize is there's two purposes of money: money for now and money for later, right? So your now money shouldn't have very much risk on it. It should be comfortably set up to give you distributions for income if you require it. And then you got to have money that's growing for later, and there's a myriad of ways to do that can beat inflation. And again, we want to make sure we take into account, are we saving, or are we paying for income for two people? Do we have things like long-term care covered in this plan? Do we have our medical do we understand Social Security decisions? Do we understand Medicare, Medicaid even? Do you understand how all those facets fit into a holistic financial plan? So yeah, I would say we do things quite differently because this is what we do every day, is work with retirees. It sounds like, and again, I don't know from the questioner, but it sounds like you have what we would call an accumulation advisor, somebody who's helped you pick some investments. They've grown in value over the years, but it's kind of just call me if you need me is kind of the
automatic pilot. Yeah, stay the course.
Stay the course. And so if you're not meeting with this advisor for 6 years, I would ask you, how are you paying them? And if you're paying them some sort of advisory fee, you ought to be doing reviews on a regular basis. So again, just if you want to get an evaluation, that's what our report card is. But even if you don't come see us, you might want to just get someone to take a look, a second set of eyes, taking a look at your stuff.
Final question this week, David, is about it's a 401k IRA question. What are the rules for rolling my 401k at work into an IRA? I want to do it while I'm still working. I know one friend who has done it, but I have another friend telling me I can't. Is he right?
Okay, so in the 401k space, you have to understand that is an ERISA plan. Okay, that's the Retirement Act that was placed in by Congress way back in 1974. So employee retirement plans, basically. So that is governed differently than an IRA. Most 401ks and some additional other types of retirement plans like 403bs may allow what's called an in-service withdrawal. Now, for this to happen, your plan is typically, and about 95% of 401ks do allow this, you have to be 59 and a half to be able to exercise this option. And what it means is that 59 and a half, once you're past that age, that's what we refer to as qualified age, you can roll a portion or all of your balance of your 401k out to a traditional IRA. This is a non-taxable event when you do it. Now, why would you do it? And what's the purpose? Because what we need to make sure you understand is it may be appropriate to do it, it may not. What are the fees you're currently paying in your 401k? And versus if you run it out to an IRA with an advisor, you're most likely going to pay that advisor some form of fee. So is it going to be more expensive? Doesn't mean it's necessarily the worst thing, but we need to disclose that. We need to understand what those fees would be. And then is it to de-risk the portfolio? Because most 401ks, Chip, unfortunately, they just put about 12 target date funds in there. These are not very good performers, historically speaking, and now they add fees because they're funds of funds. So what we would do in our case is we would evaluate that, show you what it would look like fee structure outside the IRA, also show you how to de-risk it if that's something that concerns you, and then how to allocate it based on where you are now, not just the allocation new money's going in. Now, a little trick, if you do happen to do this, wherever you do it with, is if you bring it out and you want to get less risk, if we empty the 401k out, but you're going to work another 5 years, we recommend you go full aggressive with the allocation in the 401k for the new money going in, because you're going to be dollar cost averaging starting at a zero balance again. So you don't need to be super conservative there. If we're going to have some conservative investments, principal protected things, whatever it is that your desire is, in the IRA, we've rolled it to the outside. And another big advantage I'll leave with this, Chip, is if it's in an IRA, we can start the process of Roth conversions, which is the number one tax strategy we can help retirees, especially if we do it at 59 and a half. So we can do that before they get to Medicare age and don't have to worry about things like IRMA, Medicare penalties,
Take the tax hit now, and then that money can grow tax-free. Up next, the IRS is expanding a program in which it prepares the tax return for the citizen. David Brooks has thoughts on that. We'll share them with you next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, I've put our compliance officer, Lou Brooks, on red alert here for language and possible violence. I may just lean all the way out of the camera shot here. I don't want to be within striking range. But Wall Street Journal, as a headline, I thought of you when I saw this. The IRS wants to prep your tax return. No, this is a real thing, David. It started off as a pilot program, and the IRS is just running with it. Apparently, Congress has not approved this, but that's not stopping the IRS. What's going on here?
Well, they got a big windfall with the Inflation Reduction Act, ironically, creating some inflation. But that's part of the 87,000 employee hire. They're trying to scale up, and what they want to do is they want to just fill out your taxes and tell you what you owe, and have you happily pay it and smile.
What am I missing here? That leaves me very uncomfortable.
Could this be appropriate for somebody who can't afford to file their taxes?
Okay. All right.
Entry-level employees, simple W-2, you earn, your hourly wage, and you're not earning much money.
So there really isn't any discretion. The numbers just kind of run themselves.
That would be a pretty simple thing. However, there are myriad tax credits available for those folks as well if you simply ask the right questions. And many people won't get those questions asked, at least I believe it, if the IRS were to be the one actually filling out their tax return. I would think it'd be ludicrous for any of our clients to want this to happen, because you have to understand the tax code is quite complex. And again, I'd love to see a fair tax or a flat tax style tax system. People are like, well, wouldn't you lose business? No, we'd have a whole lot more money for our clients to invest and grow. But the reality is the tax code is complicated, but it's written in incentives, right? So everything is an incentive to create behavior. That's the whole reason they create the incentive, is they know they'll drive economic activity. The whole reason you're allowed to give to charity and deduct it is because charity fulfills a role in society the government doesn't have to. Hence, they want to incentivize you to fund the charities that will do the work so that the government doesn't have to be all things to all people. Now, we've seen that run amok here lately with the government trying to be all things. But anyway, so yeah, I would wholeheartedly say no. I'd be against this. And I don't think this is going to come to pass or stay in place, because I do believe the Inflation Reduction Act is on the chopping block as soon as the new administration gets in there. I think they're going to repeal about 90% of that law through congressional passage.
I keep thinking of the line, the fact that we present in our dinner presentations about how routinely, over the course of a person's retirement, 20 or 30 years, we routinely can save clients $100,000 or more,
and
in
sometimes
taxes.
significantly more. And most people don't
I'm
realize.
not confident that Uncle Sam's going to, be as diligent for me in not collecting what he can collect.
Well, the average American pays over 50 different types of taxes in a year, and most have no idea or are not aware of it. And according to the American Tax Foundation, just the main tax that most of us are going to argue about or not want to pay is income tax, right? The average American right now in their lifetime will pay $538,000 in just that one tax. That's average. So if you're married, that's 1.1 million basically, right, in taxes. It doesn't have to be that way because there are, as I said, there are incentives to help you understand how to reduce that tax liability. Sometimes it's as simple as just doubling up your charitable giving at the end of the year or prepaying property taxes in December for February's payment if you have the room in your SALT deduction. It's understanding all the various tax credits and incentives. Seniors, if your income is not too high, you can put $2,000 in an IRA and get a $1,000 tax credit. And then people are like, wait, what? I'm like, yeah, that's free money. So again, you don't know what you don't know, which is why our tax presentations are so popular because we go over. I usually cover 3 to 5 strategies every time I speak. So I would just tell people I would not want the IRS doing my tax return. I don't think they're going to look for every possibility to reduce my tax liability.
All right. Well, you're pretty well behaved. We got through that segment in relatively good shape. Little damage done to the set or anything else. And now this one, I think this is going to be fun to talk about. You sent me a story about, the New York Stock Exchange is a venerable American institution, and it sounds like this guy was an institution within the institution. Here's the headline from CNBC. Art Cashin, New York Stock Exchange fixture for decades, dies at age 83. You knew him, David.
Yes, I did. I was blessed to meet him in 1999, early in my career. And then I actually was there doing some trading, and I was on the floor of the exchange in 2000 and got invited with a group of guys. And he's been doing this for years. And so every day, so there's a bar, if you don't know, I was just actually there. There's a bar in the exchange, right? So they actually have a bar in the exchange. And so most of the traders, as soon as the floor closes, everybody goes over there, they have one drink, and then some meander to their local habitats. And so Art was known to go to this one particular bar basically across the street and have about 20 folks with him every day. And he would just sit there for 2 hours, and he drank Dewar's Scotch on the rocks.
That's what it says in the story.
He was a storyteller of storytellers. And so my former employer was his employer, okay? So the broker-dealer that I worked for a good chunk of my career was his employer. And so we got Cashin's notes every morning. So Art he was basically what's called the floor director, but he just kind of gave commentary every day on what's going on, volume in the market, noise going on. And you got to remember, he's seen a lot. He was 83 when he passed, and he'd been at the New York Stock Exchange well over 50 years, and just a sweetheart of a guy. And he was just so beloved by Wall Street. So again, some of the articles written there from the bankers loved him, the hedge fund guys, the long guys, the short guys, political people on the left and the right. Everybody got along with Art because he was just so mild-mannered. He sang. I mean, he was just a complete character. And so, he was a joy to know.
The Friends of Fermentation, they called his group of usuals at the watering hole. But he, as you say, he was competent, though. I mean, he was working it. He was providing great advice.
Brilliant advice. And he was a really prominent figure on CNBC for the last 20 plus years. Mm-hmm. So they would frequently get his comments, especially when you had kind of the violent days up or down, 1,000, 2,000 point move days on the Dow. They would go to him for commentary because he had his ear on the floor, so to speak. The traders would tell him the real story, so to speak. So he had just an amazing amount of stories.
Well, and I think he did all this without use of a computer, right?
That's
he
correct.
Was truly old school.
Only wrote handwritten notes a couple times a day. He would write, kept almost like Sherlock Holmes, a little notepad in his hand.
They don't make him like this guy
scribe notes,
anymore.
and his assistant would come down the floor 3 times a day. She would put them all together, and then she would read it back to him, and then he would have that sent out by 6:30 every morning. We had Cashin's notes for the next day of kind of what he thought was important to pay attention to that day, whether it was an earnings report, geopolitical event, and he did. He had his ear to the ground. He was just an amazing gentleman.
Chaired the Stock Exchange's Fallen Heroes Fund for 9/11 victims. Well, what a guy. Rest in peace,
Well, another
Art
just
Cashin.
a neat tidbit of advice. Never use a credit card either. Always paid cash for
okay.
his bar bill every day, and it was quite a bar bill.
Yeah, it sounds like he must have carried a pretty large wad. Yeah, but he said he valued his privacy, so he didn't want to engage in credit cards. Art Cashin, rest in peace, Art. All right, David, in the moments we have left, these kind of lists come out at the end of the year, every year. This is Fox Business, best U.S. cities to retire in 2025. And I'm never surprised when I see Florida cities on the list. Naples came in number 1, and Sarasota's there, and I think there was a Jacksonville. Of course, you lived in Florida for many years. I was kind of surprised to see New York City number 3 on the list. There's Boise, Idaho, number 5, and Fort Wayne, Indiana, coming in at number 10. How does this list strike you, David?
Yeah, I think it's always interesting, how do they weight the things? And so this list basically looked at happiness was their number one factor. How happy are you living where you live? And so if you live in New York City, I have friends that live in New York City, right? And New York City guys are New York City guys, right?
Okay.
I'd never live outside the city.
If you have the right situation, I suppose it could be great.
Yeah, and most of those guys are don't have large families, et cetera. Everybody wants to be different. But Naples, Florida, you can make sense. That's a well-to-do community, pretty good weather, so that makes sense being number 1. Virginia Beach, where I lived as a kid, ranked number 2.
List.
Yeah, that was ranked number 2 in there. Boise, Idaho, which is really blown up, I think was number 5 on the list there. And so it's interesting to see these. Huntsville, Alabama, that's a booming economy down there. That's where we have a lot of our space programs, et cetera, there.
Weren't
Fort
you
Wayne,
in Jacksonville
Indiana.
for a while?
So I had some business in Jacksonville, but I live south of there, down near Melbourne, Florida, and Vero Beach area. So about
the
2.5
David
hours
Brooks
south.
Forrest Gump life, where you interact with everything we talk about. What were you going to say about Fort Wayne?
Oh, so like Fort Wayne, Indiana is going to kind of surprise me seeing that on the list. I have a really good friend that runs a financial practice like ours over there, and he loves that. And so, that's just kind of Midwest, what have you. So, but it's always interesting to see how these folks rank these things. So,
well, it's there for you, and if you want to check it out on our YouTube channel, feel free. That'll do it for this week, folks. Please visit our events page at retiresmartomaha.com to see everything we currently offer. No charge, no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. Try to stay warm.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.